Guys, let's look at some material in your first concept question in chapter 3, which is going to talk about that standard unmodified opinion report that you have already looked at and I hope came very close to memorizing it. Because here's the thing, I've got to point out a few things now that you need to really remember about what you've read and what you know. Okay, that report title is required to be independent. Guys, the audit report is always addressed to either the stockholders or the board of directors, guys. I've never seen it addressed to any other person. And I just want y'all to know that they're really, really big about you not addressing it to any kind of officer in the company. And if you'll have problems in the author's test bank and on the CPA exam that will test that. They'll say, is it okay to either, you know, address the CFO or the CEO of the company or something. And just remember, you never do that, okay, for an audit report. And in the opinion section, just remember that it is the auditor stating conclusions for their based on the results of the audit. So, and that they have in fact done an audit, and they've done an audit on the balance sheet, the income statement, the statement of cash flows, and footnotes. So these are items, remember, that what we call items of audit in slang term, if you would, in the profession. But those are listed in detail right there at the beginning, right there at the opinion paragraph. And then the second paragraph is going to tell you that they're fairly presented fairly, excuse me. And you got to understand that presented fairly is the same wording used now worldwide. Okay, this is a way of saying, look, we've looked at this hard enough to think that what we're looking at as far as these numbers go in this historic record of this thing called a financial statement, we believe that they are presented in a fair way and with fair amounts. Okay, but there may still be some misstatement in there. It doesn't say that they're exact or they're guaranteed or they're right? Are they accurate or anything? It just says they are presented fairly in all what? Material respects. Now we're going to get into this chapter a little bit on materiality, and then we're going to have a chapter later on materiality that will expand that even more. But we have to determine what exactly we mean by materiality, and that is a professional call by the auditor. So we'll be getting into that in this course. Okay, I'm just going to scroll down here. And I want you to realize that we mentioned the financial position and the results of operations because the financial position has become such a important statement that is embodied in what we call the balance sheet. You remember that is as of a certain date, the balance sheet. So it is a statement of financial position is the new name for the balance sheet. So we use that terminology in our new report here. Okay. And the basis of opinion, we did this audit according to relevant auditing standards. And then we make this affirmation statement that we are in fact independent and that we are in fact ethical. And we have gathered evidence that is sufficient and appropriate. And we'll understand, guys, that we'll blow this up when we get to chapter 7. And we'll start talking about the persuasiveness of evidence and how what is it you mean when you say that it's appropriate, or what does it mean when you say that it's sufficient. So we'll get to this, okay? And you'll see this kind of stuff again. Now, management, remember, is responsible for selecting accounting principles and maintaining internal control. And they're also responsible now, this is new, so they'll be tested a lot soon, and that is to assess whether or not they have a substantial doubt about their own ability to continue as a going concern. So we don't put that all on the auditor. That is on management's responsibility to figure out whether or not they can make it next year. And so that's a way of saying basically that's management's responsibility. Then that's our responsibility is to do this. If we can make that distinction, then we can then maybe just control a little bit of our liability when if we're taken to court for any reason. Okay. So let's look at auditor's responsibility. We have to make the heading now that says auditor's responsibility for the audit of the financial statements. So we want to specify in the title that the responsibility is for the audit, and specifically for the audit. And so there's a reason for that, guys. First paragraph talks about the objectives of what audit is, right? And to obtain reasonable assurance about these financial statements that are free of material misstatement due to error or fraud. Remember, that's the first thing we do. The second is to issue an opinion. All right, so reasonable assurance, all right, is obtained about whether the financial statements are free of material misstatement due to error or fraud, and then we use that assurance to issue an opinion. So we define the reasonable assurance as a risk of failing to detect material misstatement due to fraud. And we spell out that that is a greater than the risk due to error. So what we say is the risk due to fraud is considerably bigger than the risk due to error. And so we start to make that differentiation between the intentional misstatement that fraud would bring versus the accidental misstatement that an error would bring. Okay, so we're starting to make that distinction here, even with us as auditors. Okay, it's a lot harder to root out fraud, guys, than it is to find errors. Okay, now the objectives the auditor has is to obtain that reasonable assurance, right? Issue that opinion, and oh, I've already talked about this. Okay, let's see. Oh, the second paragraph here. Okay, they mention professional judgment. Don't forget that. Assessment of the risk of material misstatement considers the entity's internal control, but not for processing or expressing an opinion. Wow, what is that again? What is this? We're spelling out what professional judgment is. We are assessing the risks of material misstatement of our clients. We are considering their internal control, not for the purpose of issuing an opinion on internal control or the effectiveness of internal control, but we are trying to determine whether or not it's effective enough to be assured that the financial statements are fairly presented. Okay. We also evaluate the appropriateness of accounting policies selected and the reasonableness of accounting estimates. Remember, the word overall is important. It's the overall financial statement presentation. You can break down financial statements, guys, in segments, or you can talk about them as a whole. And at this point, at this juncture, that's what they're doing. Now, remember, too, that we evaluate as well, just like management does, the entity's ability to continue as a going concern. We've done that. And then we, of course, in the third paragraph down there at the bottom of the section that is auditor's responsibility, we state that we are supposed to plan the scope and the timing of the audit. We're supposed to report significant findings and internal control matters that may be a problem with the client. Now, remember, too, that this is non-public companies that this particular report is written for. So there might be, minimal internal control matters, and then they could be tough. And they could almost be critical control matters, too. And we will expound on that at a later date and be talking about what do we mean by plan, scope, and timing? What do we mean by what's significant? And what do we mean by internal control matters, right? So, yeah, who performed the audit is listed. The date that you complete the audit procedures needed in order to reach a goal, guys, and that goal is to obtain sufficient appropriate evidence in support of the opinion. So this is just kind of going down and getting the subtopics, the categories, if you will, of the report. I think they kind of list these on the left-hand column of the report on page 49 of your text. And And I just wanted to show you real quick, there's a couple other solutions that kind of talk about the report and kind of reinforce some of the things we just talked about. But as it relates to the report, we have a reason why there is standard wording in a report. So I want you guys to know this, right? Is that whenever these analysts go in and they look at these financial statements, and they look at these reports real closely, what they can do if they know the standard wording is that, okay, there's nothing that the auditor seems to be concerned about with this particular set of financial statements, so they've issued a standard report. And so then they can go on and do other analysis that they do in order to make a decision about whether or not to invest in stock with the company or whether or not to loan money maybe to the company, right? But the user, keep in mind, this is to protect the user standard wording, okay? You have to then, if you have a modification that comes up to the standard wording, or then if you qualify a particular report, which we'll talk about in a little while. But I mean, if you wind up changing this standard report for some reason, then the changes and the basically the differences between a standard report then and the changes that you have put into it are what is noticed, and they're what is tested on the CPA exam. So they'll give you a scenario and they'll say, this one, this and this was included in the audit report. And you know that's not, you have to know that that's not standard wording. So you have to focus in on it and kind of give an explanation for that, or click the right box, or put in the right phrase, or if it's some kind of a fill in the blank kind of simulation or something. So knowing this report is important, and can't stress that enough. I had one student just recently told me that he swore that 50% of the questions had something to do with this standard report. And since he knew the standard report so well, that he was able to pass the auditing section of the exam. So that's pretty awesome. But anyway, let me just flip back here to the numbers here, and I mean to the words. And I just want to make some points. Remember that the opinion is based on the conclusions. Okay, so that's at the end, if you will, of the audit, right? And remember the statement of whether or not it was presented fairly. This is all in the opinion section. And then we look at this one right here. Just kind of recap some stuff that's in the auditor's responsibility section. And let's talk about this again. Just reinforce it here. Objective of an audit is to obtain evidence, right, about whether the financial statements are free of material misstatement, whether they're due to error or fraud, to issue an audit opinion. So we define the reasonableness. Remember that an audit is considered a high level of assurance. An audit involves performing procedures to obtain evidence. And that is evidence, guys, about what? Well, the amounts, but not only amounts, it's also the disclosures in the financial statements. And audit procedures are very, very important because they depend on auditors' judgment, right? And those procedures are birthed from our ability to assess the risks of material misstatement in the financial statements, right? So as part of that risk assessment, we consider internal control, but we don't give an opinion on it unless we're doing a public audit. And then we have to give an opinion on the internal control because that is required by SOX, right? And the audit includes evaluating appropriateness of what? Policies used and the reasonableness of significant estimates. We will get into and discuss and expound on reasonableness of significant estimates in this class. And we will also expound on the overall presentation and the entity's ability to continue as a going concern. I wanted to come down here to this one. And I just wanted to tell you that there are 4 circumstances by which you issue a standard unmodified opinion audit report. First thing is, you may not know this, but you don't have to audit all the financial statements. You actually can audit just the balance sheet. Like a lot of banks just require that. And so, you're not auditing all the other financial statements, just that. And you can do that, which is considered a limited scope audit. And you can issue an opinion on it, but of course you can't issue a standard report because you're changing the wording on it. You've issued you have to basically say that you audited the balance sheet, but not the others. And so you're again modifying and changing the word of the standard report. So all of them have to be audited, and then you have to have sufficient appropriate evidence to be accumulated, or you can't do that, right? So there are modifications to the report and qualifications come to the report. And you'll get familiar as you go through this chapter with what those are, but they have to be, associated a lot of times with evidence. And so we need to get a sufficient appropriate in order to issue this standard report. Remember that we issue and we're looking for appropriate accounting associated with GAAP. Or it could be IFRS, if you're doing an international audit. But remember, too, that adequate disclosures have to be included in the footnotes, and they must be, remember, complete, those footnotes. So then you can issue this standard unmodified report, right? And then, of course, there's no other circumstances requiring an additional paragraph or maybe a modification or again, a qualification to the report. So we're going to talk about those things too in another video. But I just wanted to show you this that's in, some of your review notes that you're looking at and studying too. And I just wanted to focus in on those and kind of verbally talk over those, because all of those particular ones that we mentioned here, they all were associated with the topic that is that standard report. Good stuff, guys.